Okay, imagine this for a second. A future where, well, the traditional company, the big corporate giants we see as the bedrock of the economy, they start to fade. Not collapse exactly, but morph into something, well, almost unrecognizable. Where artificial intelligence, AI, automates so much, so incredibly efficiently, that owning a piece of that corporation, a stock, starts to feel a bit old-fashioned, quaint even. Like holding on to, I don't know, a share certificate from some old steam-powered mill. It sounds like pure science fiction, right? Straight out of a novel. But what if it's not? What if it's actually a reality barreling down on us, fueled by the very tech that's like everywhere in the news today? So today we're diving deep, really deep, based on some incredibly thought-provoking sources you guys sent us. We're exploring this a really bold, maybe even audacious claim from some top analysts. They're suggesting that AI isn't just making businesses, leaner and more profitable. No, they think its capabilities go way beyond that. They might fundamentally make traditional stocks, as we understand them, pretty much obsolete. And get this, in this huge disruption scenario, these same analysts, they're pointing to Bitcoin and other decentralized digital assets as the ultimate financial safe haven, the new foundation for wealth in this, well, this transformed economy. Our mission today. To unpack this potential financial earthquake, it could reshape everything we think we know about global finance. Oh, and before we really get into the weeds here, just a quick thing. If you find these kinds of deep dives valuable, exploring these big future-shaping ideas, please take a moment to hit that like button, subscribe to the channel if you haven't already, and definitely leave a comment below with your thoughts. Seriously, your engagement, it really helps us reach more people, keep this conversation going. It tells us we're hitting the right notes for you.
Yeah, it is a bold thesis, no doubt about it. The absolute core of this analysis, looking at the sources, is how they connect the dots. They link the rapid, almost exponential growth of AI to these fundamental shifts. And not just in how businesses run day to day, but in the actual economic structures underpinning everything. And from there, they draw this direct, almost straight line to the changing role and maybe the eventual diminished relevance of traditional stocks, of equity. Now, let's be clear, it's not presented as a guarantee. It's framed as a disruption scenario. But it's a really well-reasoned one, and it absolutely deserves serious thought. So our goal today is to really dissect these arguments, look at the evidence that might already be showing up, and try to grasp the implications. Because, honestly, they're profound. For every single type of investor, whether you're just starting out or managing, huge assets, it really challenges some core assumptions about value and ownership.
Okay, right. Let's unpack this prediction then. AI making stocks obsolete. I mean, it still sounds kind of cyberpunk, doesn't it? Like something from a movie. But the reasoning our sources lay out, it's surprisingly concrete. And when you start following the logic, it begins to feel, well, almost eerily plausible. Maybe even logical in a scary way. So the analyst's main point isn't just about like AI making things a bit faster or cheaper. A 10% boost here, 20% there. No, they're arguing AI is poised to fundamentally disrupt, completely redefine traditional business models right down to their foundations. It could transform the very essence of what a corporation is. So how does that actually happen? How does this disruption unfold? Let's break down the mechanisms they're talking about. First up, the automation of corporate structures themselves. And picture this, we're not just talking robots on an assembly line. We're talking AI systems potentially taking over management functions, operations, even really complex strategic decision-making.
At all levels.
Imagine an AI not just optimizing a supply chain, but, say, predicting geopolitical shifts that could impact raw material costs, then autonomously rerouting global logistics, maybe even negotiating new supplier contracts using advanced language models, all without a human needing to directly sign off.
Right, it's moving from human oversight to AI initiative. That's a huge leap.
Exactly. So the traditional corporate ladder, all those layers of middle management, department heads, even some C-suite functions, they could become increasingly unnecessary for a lot of decisions. The company's brain, so to speak, shifts from being a bunch of human minds to this complex, self-learning algorithm.
And that leads straight into the next point, doesn't it? The shrinking workforce and overhead costs.
Precisely. If AI integrates that deeply, companies might drastically cut down their human workforce. And not just in manual jobs, across the board, white-collar professions too. Think about AI handling maybe almost all customer service, running incredibly complex data analysis, automating accounting, maybe even generating first drafts of creative stuff like marketing copy or design ideas.
We're already seeing pieces of this, things like RPA in back offices.
Yeah, but scale that up massively. This isn't just trimming the fat, it's potentially making huge sections of the human workforce obsolete or significantly less needed. So what does that mean? Well, Way less need for giant office buildings, fewer traditional employee benefits packages, a massive drop in all those costs tied to having lots of people. Companies could become incredibly lean, almost like ghost entities, operating with maybe just a small core team of highly specialized humans overseeing this vast network of intelligent AI systems.
And what does a brand even mean then? If the decisions are algorithmic, how do you judge leadership when it's basically code? The whole character of the company changes.
Right. And that brings us to the absolute core of their argument. Potentially less need for traditional equities, for stocks. If companies become less about human capital, less about the combined effort and smarts of thousands of employees driving growth and innovation, and more about these autonomous AI systems, their algorithms, their intellectual property, does the whole idea of owning stock lose its historical punch?
Because historically, a stock represents a share in that human-driven enterprise, right? A piece of the future profits generated by people.
Exactly. But if the company is largely an automated black box, an efficient algorithm just churning out results, why would you want a piece of that in the same way? The old metrics we use to value stocks, headcount growth, market share won by human sales teams, R&D driven by human engineers, they might just become less relevant.
Investors might really struggle to see the inherent value or the growth potential in something where the main value driver is a non-human system, a system that maybe could be copied or just leapfrogged by a better AI tomorrow.
It's this fundamental rethink of what makes a stock a good long-term bet. That's the heart of the disruption scenario.
Okay, so if that happens, if traditional equity ownership, tied so deeply to human capital and these corporate structures becomes less compelling because of this AI transformation, well, that immediately throws up a massive question, a multi-trillion-dollar question, really. Where does all that capital, all that wealth currently tied up in stocks actually go? And this is exactly where Bitcoin steps into the picture in these analyses. It's positioned as the ultimate hedge against this kind of, frankly, unprecedented corporate decline and economic restructuring.
Okay, so why Bitcoin specifically? What makes it the ultimate hedge in this scenario?
Right, let's dig into that. There are a few key reasons highlighted. Firstly, it's absolute scarcity. That's a really powerful counterpoint to potentially devalued corporate assets. Bitcoin has a hard cap, right?
Okay.
21 million coins. Mathematically fixed, impossible to change. Now think about a world where AI might drive the cost of producing goods and services way down, potentially even towards zero. That could create deflationary pressures, maybe diminishing the value of traditionally produced things.
So something truly scarce, like Bitcoin, stands out.
Exactly. It's like a hard asset, but in digital form. And critically, it's not burdened by the corporate structures that AI might be making obsolete. Unlike company shares, which can be diluted if the company issues more, or fiat currencies, which, well, we know central banks can print more of, Bitcoin's supply schedule is fixed. It's immutable. You can check it on the blockchain. It's not just a number. It's like a fundamental economic principle built into the code.
Okay, scarcity, that makes sense. What else?
Secondly, it's neutral, fundamentally neutral. Bitcoin operates completely independently of any single company or any single national economy. This neutrality gives it this perceived immunity to the whole corporate decline scenario AI might trigger. If major companies consolidate or struggle or just become less relevant because of AI efficiency, Bitcoin, as this global permissionless network, it just keeps ticking along, running as designed.
So it doesn't care if company X or country Y is having problems.
Pretty much. It's unaffected by their balance sheets, their strategic pivots, even the political games nations play. In a time when even powerful countries are facing, let's say, unique economic pressures, Bitcoin kind of offers this digital Switzerland, a neutral, apolitical zone for wealth that exists outside traditional borders and corporate loyalties.
Interesting analogy. Digital Switzerland. Okay, and the third point.
Decentralization. This is absolutely crucial. Bitcoin has no central point of failure, no CEO to make a bad call, no headquarters to get shut down. Now, contrast that sharply with centralized corporate structures. They are inherently vulnerable, right? Vulnerable to being consolidated by super efficient AI entities, vulnerable to being outcompeted by a rival's AI breakthrough, or even just becoming obsolete.
Right, a single point of failure is a big risk.
Definitely. In a decentralized network like Bitcoin, the value isn't concentrated in one place that can be attacked, mismanaged, or just disrupted. It's spread across this global network of participants, miners, nodes. That makes it incredibly resilient. Its very architecture protects it from the kinds of risks AI is predicted to bring to traditional centralized companies.
So scarcity, neutrality, decentralization. Those are the pillars.
Exactly. And zooming out, it connects to a bigger picture. This isn't just about, oh, here's a new asset class. It's potentially about a fundamental shift in what we even consider a valuable store of wealth, especially in a radically different economic future. Investors, whether they're individuals like you listening or huge institutions, they'd naturally look for assets that are, well, maybe anti-fragile things that actually get stronger from chaos. Assets that aren't correlated with the very systems undergoing this massive transformation. Assets with inherent verifiable scarcity. And from that viewpoint, Bitcoin seems to fit the bill perfectly in this scenario. It offers a really stark alternative to the potential instability of an AI-disrupted corporate world.
Okay, this is where it gets, I think, really fascinating and maybe a little unsettling when you consider the scale. How exactly does AI disrupt companies to this degree? It's not just, like I said, a robot vacuum cleaner. It's systemic. It's about changing how value is created, how it's distributed, how it's captured. Our sources really dig into the why this matters with some compelling details.
Yeah, the mechanisms are key to understanding the potential impact.
Right. So let's expand on that workforce reduction and overhead point again, because this is where the human impact really hits home. Imagine AI systems automating roles not just at the bottom, but right across the organization. Repetitive manufacturing tasks, sure, but also complex analysis done by middle managers, maybe even parts of strategic planning. We mentioned robotic process automation, RPA, that's already streamlining back offices, cutting costs.
But that's just the beginning, potentially.
Exactly. Scale that up. Imagine AI running the entire supply chain, predicting demand, managing logistics globally, handling customs, negotiating with suppliers and distributors, all autonomously. Minimal human input needed. This could lead to massively smaller workforces across almost every industry. Think manufacturing, services, finance, everything. And that means profoundly lower operational costs.
So the company's structure fundamentally changes. Maybe a tiny core of highly skilled humans overseeing this huge algorithmic workforce.
Yeah, the whole economic engine shifts away from primarily human capital. That's a massive change. Then there's the potential for consolidation. This is huge, too. If AI makes operations that efficient, creating these incredible economies of scale, the competitive landscape could just shrink dramatically.
Fewer, bigger players dominating everything.
Potentially. Imagine entire industries, not just sectors, industries that used to have dozens, hundreds of competing firms, now dominated by maybe just 2 or 3 global AI-managed giants. These giants, running super lean with minimal human overhead and maximum algorithmic efficiency, could just achieve a level of market power that smaller, less AI-savvy companies simply can't match. It's like corporate Darwinism on hyperdrive.
So for an investor, that means fewer choices, fewer viable companies to invest in.
Exactly. A dramatically reduced number of traditional stock opportunities because the market becomes so concentrated, dominated by these few hyper-efficient AI-driven players. And finally, this is critical investor perception. How do investors feel about stocks in this scenario? If companies aren't growing primarily by hiring more people, opening new factories or offices, or winning market share through traditional human efforts, investors might just look at stocks differently.
The whole narrative changes.
Right. The story of owning a piece of future human progress kind of loses its shine if the progress is mostly algorithmic. The metrics we rely on today, earnings reports, PE ratios, growth forecasts tied to human innovation, they might become less reliable, less meaningful.
How do you value an AI's management quality or its competitive moat if another AI can just leapfrog it?
Exactly. So this could trigger a fundamental reevaluation of what makes a stock a good long-term hold, potentially leading to a huge shift of capital out of traditional stock markets.
And that contrast is really what drives the argument here. If these traditional human-centric companies are vulnerable to AI's power, leading to fewer jobs, industry consolidation, shifting value perceptions, then Bitcoin offers something entirely different. It's presented not just as an alternative asset, but almost like a different financial species, one that's inherently immune to these specific AI-driven pressures.
No, exactly.
Well, one of its most powerful features here is its immunity to corporate decline. Because fundamentally, Bitcoin isn't a company, it's a protocol, a peer-to-peer network. It has no CEO, no board, no employees, no headquarters, no quarterly earnings tied to human performance. Critically, it doesn't need a traditional corporate structure to exist or for its value to be recognized.
Its operations are just the network itself running the code.
Precisely. The transaction recording, the verification, it's all handled by this decentralized global network of miners and nodes following transparent cryptographic rules. So even if, hypothetically, every single Fortune 500 company became one of these automated ghost entities struggling for relevance, Bitcoin would just keep on running exactly as it's designed to. It's completely separate from corporate balance sheets, human decisions, or market trends affecting companies. It's more like a decentralized public utility than a private enterprise.
Okay, that makes sense. It's separate.
And that leads straight to this fundamental shift the sources talk about. Moving from owning a piece of a company to owning truly sovereign digital property. Bitcoin represents this unique kind of digital property. It has these intrinsic verifiable features: absolute scarcity, resistance to censorship, immutability. When you hold Bitcoin, ideally, you hold the private keys, giving you direct control over that asset.
Which is different from a stock certificate.
Totally different. A stock gives you fractional ownership in this complex, centralized entity, an entity subject to regulations, market sentiment, human leadership failures, and now, potentially, AI disruption and obsolescence. In a future where the value of corporations might become harder to pin down because of AI, owning something you directly control that's digitally scarce, globally accessible, and independent, that becomes incredibly appealing as a foundational way to store wealth.
Okay, so if this plays out, what does it mean for the big picture? The global financial landscape, not just specific companies, but the flow of money worldwide. Our sources suggest something huge, a massive capital reallocation. And we're not talking small shifts here. We're talking potentially trillions upon trillions of dollars looking for a new home, potentially rewriting the rules of global markets.
Yeah, the scale is mind-boggling if this thesis holds true.
So if confidence in the long-term value and growth of traditional stocks really takes a hit because of AI disruption, eroding profits, sidelining human innovation, concentrating markets, where does all that money currently parked in stocks actually go? Historically, a huge chunk of global wealth held by individuals, pension funds, sovereign wealth funds, big corporations is in equities. If that core investment idea starts to wobble, that capital isn't just going to disappear. It's going to actively search for new places to go. Assets that offer more stability, maybe more reliable growth, or just act as a better store of value in whatever this new economic reality looks like.
It wouldn't be a trickle, it'd be potentially a flood moving elsewhere.
Exactly. And this leads us to think about other alternative stores of value, not just Bitcoin, although Bitcoin is definitely positioned as the primary beneficiary in this narrative. Our sources do mention gold, for instance, and also these emerging tokenized real-world assets, RWAs.
Gold makes sense, the traditional safe haven.
Right. Physical, scarce, known for centuries as an alternative to fiat money and corporate paper. But it doesn't have Bitcoin's digital native qualities, its ease of transfer, divisibility, programmability. Tokenized RWAs, though, that's a whole new frontier. Imagine taking things like prime real estate, famous art collections, maybe even intellectual property rights, and representing fractional ownership of them as tokens on a blockchain.
Bringing liquidity and transparency to traditionally illiquid assets.
Exactly. Suddenly, these assets become much more transparent, easier to trade, more accessible to a wider range of investors. So the point is, this isn't just about one or two companies or even just Bitcoin. It's about trillions of dollars, potentially shifting, fundamentally changing market structures, and maybe even our definition of what a safe or growth investment really is.
What's really insightful here, I think, is that even if this whole scenario unfolds slowly, maybe over decades, just the narrative shift itself could create significant market dynamics right now. For traders, for investors, it's a powerful psychological element. The growing awareness, the increasing discussion and acceptance of AI's potential to disrupt stocks, and the corresponding shift in how people view decentralized assets. That alone can change market behavior long before the full disruption actually happens.
So the expectation isn't necessarily a sudden crash, but maybe increased turbulence.
Yeah, the prediction is for potentially significantly increased volatility in traditional stock markets. And maybe new kinds of volatility patterns in assets like Bitcoin, too. As this narrative gains traction, the story shifting away from equities towards decentralized stores of value market sentiment could become really unpredictable. We might enter a world where the traditional fundamentals we rely on, quarterly earnings, PE ratios, growth based on human expansion, become less reliable guides to future value.
Because the underlying assumptions are changing.
Exactly. Instead, capital flows driven by this big disruption narrative, shifts in investor psychology, a flight to perceived safety. Those could become the dominant forces driving prices. Traders would need to adapt big time. Establish technical analysis, fundamental frameworks, they might all need serious reevaluation.
So it becomes more of a narrative-driven market.
That's a good way to put it. A market where perception, speculation, the unfolding story of technological change and economic transformation maybe plays an even bigger role than traditional fundamentals in driving price action. Traders would need to be incredibly tuned in to these sentiment shifts, the flow of information, the evolving understanding of value and risk in this rapidly changing world. It's a huge departure from the strategies that have worked for decades. It really calls for a new kind of market literacy.
Okay, so let's bring it down to the individual level.
Hmm.
How does this radical scenario, even if it unfolds slowly, play out for you, the retail investor, just trying to navigate all this?
Our sources suggest a pretty profound shift in behavior and strategy. The idea is that retail investors might increasingly start moving their portfolios away from traditional stocks, especially in sectors that look vulnerable, maybe heavily reliant on human labor or old corporate models, and start allocating more towards Bitcoin and maybe similar decentralized assets.
A strategic shift, not just tactical trading. Right. And it's not just about changing what you own, it's about a deep mindset shift. In this new world, Bitcoin stops being seen as just, a risky tech bet or some high volatility gamble. It starts being viewed as digital property, a fundamental asset class in its own right, seen as distinct from and potentially better than corporate stocks in this AI-driven future.
It's about owning something immutable, provably scarce, fundamentally sovereign outside the direct control of any single company or government.
Yeah, in a world where maybe everything else feels increasingly uncertain, centralized, or up for grabs. It's like a change in the very definition of what counts as a safe or foundational asset for your long-term wealth. A shift in the bedrock concepts of personal finance.
Which really forces you to ask yourself some hard questions.
Totally. It's fascinating to think about personally. Do you really buy into this idea that AI could make stocks obsolete? Or is this just, another wave of hype that'll eventually die down? And if you had to place your bets for the next, say, 10 years, where would you put your long-term capital? Would you rather own Bitcoin, or would you rather own shares in the absolute cutting-edge AI companies themselves? Considering everything we're laying out, it really makes you think about where your conviction lies regarding the future of finance.
And it's definitely not just retail investors wrestling with this.
Oh, absolutely not. Our sources point to an equally significant, maybe even more impactful shift happening at the institutional level. We're talking about the big players here. When we say institutional adoption in this context, we mean the truly massive pools of capital pension funds, endowments managing university money, sovereign wealth funds for entire nations, huge asset managers. Collectively, they control trillions and trillions of dollars.
And the idea is they could start strategically rebalancing those massive portfolios in response to this disruption scenario.
Exactly. So what specific actions might we see from these giants? Well, one obvious one is increased allocation into Bitcoin ETFs. The launch of regulated spot Bitcoin ETFs in major markets like the US has already lowered the barrier significantly. It makes it much easier for institutions to get exposure without the headache of direct custody.
Removing friction is key for them.
Definitely. And beyond ETFs, institutions would be looking seriously at sophisticated Bitcoin custody solutions, ways to securely store billions of dollars worth of digital assets in a compliant way. And more broadly, we might see a general strategic reduction in their exposure to traditional stocks as the long-term appeal and growth story perhaps starts to fade under AI's influence.
So this isn't just about a few adventurous hedge funds anymore.
No, this is potentially about the pillars of the financial establishment, pension funds looking after retirement money for millions, university endowments funding research, major financial institutions considering a completely new asset allocation playbook. Moving away from a stock-centric model to one that integrates decentralized digital assets as a core foundational piece.
Okay, so if the traditional corporation is potentially disrupted, diminished by AI, what fills that gap? What organizational structures might rise up instead?
Right, and this is where the whole Web3 ecosystem offers some really interesting and already existing answers. Specifically, Decentralized Autonomous Organizations, or DAOs. Our sources suggest that the very disruption AI causes could actually fuel the growth and adoption of DAOs. They might be seen as a more resilient, more transparent, more decentralized alternative to the old corporate model.
DAOs as the new companies for a digital AI-driven age.
Kind of, yeah. Instead of the top-down hierarchy CEO, board, managers, DAOs are typically governed by their community. The rules, the decision-making processes, they're often baked right into the code on a blockchain.
Yeah.
That makes them incredibly transparent, auditable, hard to tamper with.
Decisions made by token holders voting on proposals.
Often, yes. It gives the community direct power. This transparency, this resistance to centralized control or mismanagement, It stands in pretty sharp contrast to traditional corporations, which, let's be honest, have historically been vulnerable to opaque decisions, executive scandals, or just plain bad leadership.
We've certainly seen examples of that.
For sure. So if traditional corporations do start to shrink or morph under AI's influence, becoming these leaner, maybe ghost entities, then DAOs and the broader Web3 approach could genuinely emerge as the dominant way to organize value creation, manage projects, even handle governance in a more decentralized, automated world. It raises huge questions about the future of work, enterprise, and how we collaborate.
And if we connect that to the investment side, a world with potentially fewer reliable dividend-paying stocks, or where dividends from these highly automated companies seem less robust, well, investors are naturally going to look for income somewhere else.
Makes sense. People still need yield.
Exactly. And this is where crypto-native yields become incredibly relevant. These are alternative income strategies that are kind of baked into the Web3 ecosystem itself, and they're fundamentally different from traditional corporate payouts.
Okay, like what's specifically? Assuming our audience has some baseline familiarity here.
Right. Well, first, there's staking. In a traditional company, maybe you get dividends from profits earned by human effort. In Web3, especially with proof-of-stake blockchains, you can stake your crypto. You lock up your assets to help secure the network, validate transactions, and for doing that, for participating in maintaining this essential decentralized infrastructure, you earn rewards, a yield.
And that yield isn't tied to a company's performance.
Nope. It's protocol native. It comes from the network's own issuance of new coins or from transaction fees. It's a fundamentally different bet. You're not betting on human ingenuity inside a company. You're betting on the resilience and utility of the network itself, this digital public good.
Interesting distinction. Okay, what else besides staking?
Then you have the whole world of decentralized finance, or DeFi. This is a massive suite of financial services built on blockchains, operating entirely without traditional middlemen like banks or brokers. You can lend your crypto out directly to others through protocols like Above or Compound and earn interest. You can provide liquidity to decentralized exchanges like Uniswap and earn trading fees. You can engage in all sorts of complex financial activities, all generating income based on the actual demand for these decentralized services.
So peer-to-peer or protocol-to-peer income streams.
Exactly. Often with more transparency and sometimes higher yields precisely because you're cutting out layers of intermediaries.
Okay, staking, DeFi, any others?
And then there are those tokenized assets we mentioned earlier, representing real-world things as tokens on a blockchain. This opens up potential income streams directly from the underlying asset. For instance, imagine a token representing fractional ownership in an apartment building. It could be programmed via a smart contract to automatically pay out the rental income directly to the token holders each month.
Or royalties from intellectual property.
Potentially, yes. The point is, it's not just a different source of income, it's a fundamentally different model for creating and distributing value. It moves away from centralized corporate dividends towards more direct, transparent, potentially higher yield opportunities within these open, permissionless networks. It really empowers individuals to participate in new economic models directly.
You know, this brings us to a really profound idea, a potential convergence point. AI and blockchain technology coming together to fundamentally reshape global finance. Not just tweak it, but radically overhaul it.
The synergy there could be incredibly powerful.
Yeah, imagine a world where AI is generating capital, managing huge asset portfolios with incredible speed and predictive power, executing complex financial strategies autonomously. But now, picture all of that happening on top of the immutable, transparent, decentralized rails of blockchain technology. This isn't just AI helping a bank run its internal systems better. This is AI potentially becoming a major participant in the financial system, or operating within a completely new kind of system enabled by decentralized infrastructure.
AI agents operating directly on chain.
Exactly.
Yeah.
Sophisticated AI agents transacting autonomously on a blockchain, executing smart contracts that manage complex financial agreements, allocating capital across global DeFi markets, making dynamic investment decisions without direct human intervention, but all of it verifiably recorded and transparent on a public ledger.
That could create an entirely new kind of financial system, hyper-efficient, maybe much more resistant to traditional types of fraud or corruption or those single points of failure we talked about, and potentially far more accessible to people globally.
It's this vision where you combine AI's incredible strengths in processing data and making predictions with blockchain's foundational strengths in security, transparency, and decentralization. The result could be an economic landscape that looks vastly different from anything we recognize today.
It sounds incredibly futuristic, almost like science fiction territory still.
It does. It totally does. But, our sources actually point to several real-world examples that are already hinting strongly at this future we've been mapping out. These aren't just abstract theories. They're concrete actions being taken right now by companies, major investors, even entire countries. They signal that this shift might already be underway.
Okay, like what? What tangible evidence are we seeing?
Well, let's take MicroStrategy. We probably all know this story, but it fits perfectly here. This big enterprise software company, led by Michael Saylor, made a massive strategic pivot to adopt Bitcoin as its primary treasury reserve asset.
They went all in, basically, using cash reserves, even taking on debt to buy Bitcoin.
Exactly. It was a direct, explicit choice over holding traditional assets like cash, bonds, or even gold in their corporate treasury. Their whole philosophy is that Bitcoin is a superior store value, this digital property immune to inflation and the risks plaguing other assets.
It's a massive corporate bet on this exact thesis we're discussing.
It absolutely is. It's a loud statement saying, we believe Bitcoin is a better long-term store of value than traditional corporate assets or government money in this era of huge technological change and monetary expansion. Then you've got El Salvador. Not a company, but a whole country. They adopted Bitcoin as legal tender alongside the U.S. dollar.
A sovereign nation making that move is pretty remarkable.
It really is. Their reasons were complex, trying to cut remittance fees for citizens abroad, boost financial inclusion, attract investment. And yeah, it hasn't been without its challenges or criticisms from bodies like the IMF.
Sure.
But El Salvador's move shows a nation putting its faith in Bitcoin as a stable, independent store of value and means of exchange. It further validates this narrative of Bitcoin as a potential escape hatch from traditional financial system issues and a viable alternative to legacy economic models.
And then there are the big predictions, like from ARK Invest.
Right. Kathy Wood's ARK Invest. They've consistently published research forecasting Bitcoin reaching, $1 million or even more per coin in the coming years.
And their reasoning aligns perfectly with this capital reallocation idea, doesn't it?
Absolutely. Their analysis hinges on Bitcoin's scarcity, its growing institutional adoption, and its potential to just hoover up a significant chunk of global capital currently sitting in other assets, starting with gold, maybe moving on to bonds and even equities.
They see it as a foundational asset for the future, not just a quick trade.
Exactly. So these aren't just fringe ideas. We're seeing major companies, sovereign nations, and influential investment firms acting on or predicting scenarios very much like the one we're exploring today. The groundwork is being laid.
And what's also compelling is looking at existing Web3 projects that already show these decentralized alternatives work in practice. They're not just theories on a whiteboard, they're operational entities, proving that parts of this disruption scenario are actually viable right now.
Showing that these new companies can actually function.
Exactly. Take MakerDAO, for example. It's probably one of the most prominent DAOs out there. And it essentially functions as a decentralized bank or financial institution. It issues the DAI stablecoin, manages a huge treasury of crypto assets, all without a traditional CEO, board, or headquarters. Decisions about the protocol, managing risk, handling the treasury, it's all done by the holders of the MKR governance token through transparent on-chain voting.
Governed by smart contracts on Ethereum.
Right. It directly competes with traditional finance players, offering this transparent, globally accessible alternative that runs 24/7. It's a powerful working example of how a complex financial entity can operate using decentralized code-based governance. It really showcases an alternative to the centralized corporate model that might be vulnerable to AI.
We also have to talk about the flip side, though, the cautionary tales, like FTX.
Absolutely. The collapse of FTX serves as a really stark warning. The centralized control, the fraud, the utter lack of transparency. It was a disaster. And what happened? It pushed a lot of investors, both retail and institutional, further towards truly decentralized and transparent systems. It hammered home the risks of trusting centralized entities, even ones within the crypto space itself. Human error, greed, they can still lead to catastrophic failure in centralized systems.
So paradoxically, FTX might have actually strengthened the case for decentralization.
In a way, yes. It tragically highlighted the vulnerabilities of centralization, and it reinforced the appeal of things like Bitcoin or well-structured DAOs, systems designed to be resistant to those kinds of single points of failure, both technologically and in terms of human integrity. It definitely raises a big question. Are we seeing a broader, growing distrust in all centralized entities, whether they're old-school corporations or newer centralized crypto players? And will this push people towards truly decentralized, auditable, code-governed systems as the safer, long-term bet? Feels like that might be part of the trend.
Okay, so given this whole potential disruption, this huge shift we've been talking about, how do we actually track it? How do we measure if this scenario is really unfolding? Our sources give us some concrete metrics, some charts, things we should be watching very closely.
Yeah, we need tangible data points to see if capital is actually moving in the ways this thesis suggests.
Right, so one key thing to watch is simply the performance comparison. Bitcoin versus, say, the S&P 500 index, representing traditional stocks. We need to constantly compare how they're doing over major market cycles. Not just who has the higher return overall, but looking for times when Bitcoin significantly outperforms or behaves very differently, especially when markets are stressed or the economy looks shaky.
If Bitcoin holds up or even rallies while stocks are tanking, that's a strong signal.
Exactly. If it consistently outpaces traditional stocks, and especially if it shows resilience when traditional markets are weak, that really lends weight to the idea that it's being seen as a superior store of value in this changing environment. It's about watching where the money is actually flowing under pressure. Another critical thing to look for is correlation breakdown, or maybe decoupling.
Seeing Bitcoin move independently of the stock market.
Yeah. We need to look for periods where Bitcoin stops moving in lockstep with the stock market, especially during macro crises, big economic downturns, periods of high inflation, geopolitical shocks. If Bitcoin is acting as a true alternative, a real safe haven, and not just another risk-on asset that goes up and down with everything else, we'd expect to see it diverge when traditional markets are freaking out.
Like during a major liquidity crunch, if the S&P drops hard, what does Bitcoin do? Does it drop too, or does it hold steady or even rise? That divergence is key.
Absolutely. That decoupling would strongly suggest investors are starting to treat it as a separate, uncorrelated asset class, something untethered from the fate of corporate America and traditional finance. These metrics aren't just academic. They could be charting a massive reallocation of global wealth in real time.
And zooming out again, these metrics, these charts, they're not just abstract numbers. They represent real shifts happening underneath the surface, shifts in investor behavior, in conviction, in the whole perception of what constitutes value. They give us tangible proof of how capital is moving and where trust is being placed in the face of this potential disruption.
So what are some other indicators of that conviction?
Well, a really critical one to monitor closely is Bitcoin ETF inflows. The sheer volume of money flowing into these regulated exchange-traded funds is a powerful proxy for institutional capital finally moving into Bitcoin in a serious way. Seeing significant, sustained inflows, especially from big, established financial institutions, would be a major signal. It would suggest a strategic rebalancing away from equities by these huge players is actually happening.
It shows increasing comfort and belief in Bitcoin as a legitimate long-term asset for serious portfolios.
Exactly. It's a bellwether for mainstream adoption, moving Bitcoin from a niche speculation to a foundational investment vehicle in their eyes.
What about on-chain data? Can that tell us anything about conviction?
Oh, absolutely. On-chain analytics offer insights you just can't get from traditional market data. Specifically, monitoring the long-term holder supply is incredibly revealing. This metric basically shows how much Bitcoin is being held for extended periods, think months, or even years without being moved or traded. A growing long-term holder supply indicates strong conviction. It suggests a large portion of the market believes in Bitcoin's enduring value, especially as a long-term store of value resistant to stock market swings and this potential AI disruption.
So it tells us people aren't just flipping it for short-term gains.
Exactly. It shows accumulation, a belief in holding for the long haul, a commitment to its foundational role in the future. That's a powerful sign of deep conviction.
Okay, one more comparison seems crucial here. How do the hot AI stocks themselves perform relative to Bitcoin?
Yes, that's absolutely essential to watch in this specific scenario. Comparing the performance of, say, AI sector stock indices against Bitcoin's performance, it forces that crucial question for investors. Where do you place your bet when facing the cutting edge of tech? Do you invest in the traditional equity of the companies building the AI, hoping to profit from the disruption they cause?
Hmm.
Or do you invest in a decentralized asset like Bitcoin, which is being positioned as potentially immune to AI's disruptive effects, offering a hedge against that very transformation? Watching which asset class attracts more capital, which delivers better returns during this intense period of technological change, that will be a massive indicator of which narrative is winning and where the smart money is ultimately placing its bets. It's a direct face-off, investing in the tools of disruption versus investing in the potential shield against it.
Okay, so let's try to wrap this up. This deep dive into AI, stocks, and Bitcoin's future. Disruption scenario. We've really explored a radical thesis today. The core idea, just to summarize, AI's transformative power might go so far as to make traditional stocks, as we've known them, largely obsolete. Not just making companies more efficient, but fundamentally changing their structure, shrinking workforces, maybe turning them into ghost entities, and ultimately diminishing the relevance of owning traditional equity.
And in that potentially seismic shift.
Right, in that huge shift, Bitcoin and other decentralized assets are presented as the ultimate financial safe haven, positioned to attract potentially massive amounts of capital flowing out of traditional markets, and maybe redefining global wealth itself. We've talked about the huge implications for literally everyone involved in finance, from individual retail investors rethinking their portfolios to giant institutions contemplating a multi-trillion-dollar reallocation towards digital property and alternative stores of value.
We also touched on how Web3 concepts like DAOs might emerge as the new forms of organization.
Yeah, DAOs potentially replacing corporations. And how crypto native yield staking DeFi could reshape how we generate income in a world less reliant on corporate dividends. This deep dive, it feels like it's given us a glimpse into a future that might still seem kind of distant, maybe even far-fetched to some. But the building blocks, they're already here. From MicroStrategy's treasury strategy to El Salvador's national adoption to the very real functioning of DAOs like MakerDAO, these tangible shifts are happening right now. The pieces are on the board.
Which leaves us with a really profound closing thought, I think. If the very definition of a company is truly evolving, being fundamentally reshaped by the relentless advance of artificial intelligence, what does ownership really mean anymore? What truly constitutes value in this coming digital era? Is it owning a fractional share in an automated entity, an entity run mostly by algorithms with minimal human input where value creation might be kind of an opaque algorithmic process? Or is it holding a direct stake in a decentralized sovereign network, something that exists independently of any company or country, governed by transparent code, defined by provable scarcity? This isn't just some academic debate. It's a fundamental question about the future of capital, about wealth preservation, and how you answer it could profoundly shape your financial future for decades to come. It's something that demands really careful, ongoing thought as technology continues to accelerate.